6 dividend increases you need to know about. Let's take a look at each of these companies. Let's have a brief look at their dividend safety, some of their financial metrics for each one, and let's also put them through our valuation model and find out whether or not they are undervalued and what are acceptable buy prices for each of these companies. So the first one, we have Mastercard, and you will not be surprised to hear a 16% dividend increase for this phenomenal company. Up 18% year to date. They are trading towards the upper end of the 52-week high, and even with their increase, we do still see that yield very minuscule at 0.64%, although investors who do have this company will be liking their share price appreciation, as over the last 10 years, this company continues to increase up 419%. Now, in terms of their dividend safety, again, it shouldn't come as any surprise. A score of 99, very safe. Market cap 385 billion. They are a mega cap company. Now, one thing to note, if a recession is incoming, well, what happened in the previous recession? They in fact maintained their dividend. They didn't increase it, but they also didn't cut it. We see recession sales positive, plus 2%, above the average growth of companies in the S&P, which was negative. But they also did perform way better than the S&P, only down 12% versus the S&P's negative 55%. Now, dividend growth, as we mentioned, a very nice increase this month. Great to see double digits. But on top of that, the consistency is phenomenal. 18% on average over the last 5 years. 33% on average over the last 10 years. Absolutely incredible. And they have been increasing their dividends for the last 11 years, year on year. Now, dividend yield theory, as we see, it shows a company is undervalued when the current yield sits above the 5-year average. So you may be surprised to hear that it is a signal right now of undervaluation. But as always, we never look at any of these models in isolation, and we do tend to draw our conclusions towards the end. Also, the forward PE sitting at 30 versus the 5-year average of 33. Now, in terms of the sector PE comparison, it is well above the sector PE of 10.8, and as mentioned, trading towards the upper end. Now, free cash flow payout. It is important to keep this below 60% so we can continue to see double-digit increases. And in fact, it's been consistently below 30%, with the last full year at 20% and 2023 expected to be 22%. So we do love to see that. An absolute free cash flow machine. Their free cash flow per share has increased by more than 3 times. 317 in 2013, 1040 in 2022, 2024 expected to be even higher at 1360. In terms of sales growth, it comes as no surprise. Double-digit increase nearly every single year for the last 10 years. We do see that dip due to COVID, in my opinion, of negative 9%. And look at that lovely rebound to 23%. 2022 at 18%, with the trailing 12 months showing 2023 expected to be around 13%. Keeping up with those double-digit increases we love to see. And numerically speaking, we can see the top line has nearly tripled over the period from 8.3 billion to 22 billion. And on top of those double-digit increases, they also do a significant amount of share buybacks. They've also authorized share buybacks as well. 1.22 billion in 2013, 971 in 2022. So we love to see that. Companies returning excess cash to investor pockets. ROIC, what can I say? I look for 10% or more. Mastercard absolutely blowing that to pieces. 40% over the last few years. 46 in 2021, and we see 59 in 2022. And let's look at that trading 12 months. 63 expected in 2023. Absolutely phenomenal. Management do know how to effectively allocate their capital. Operating margin, free cash flow margin, nothing much to say other than they are consistently well above the minimums we look for, in the mid-50s on the operating margin and in the mid-40s in the free cash flow margin. Net debt to EBITDA showing us the strength of the balance sheet as well as the dividend safety. These show us the number of years it would take the company to pay off all of their debt net of cash on hand. And what we can see here, it would take them approximately half a year in 2022 and pretty much the same expected in 2023. So that dividend does seem to be very safe for Mastercard. Now, in terms of the valuation, as always, if you do enjoy the content values being provided, don't forget to smash the like button and hit that subscribe and bell button so these videos are continually dropped to your doorstep. So what we do on the channel is we typically run through each of these models in detail. However, for today's episode, we are just running at the output tab. And as always, we don't typically use all valuation models for all companies as they're not applicable. And we do explain this in the individual videos. So the intrinsic value we arrive to for Mastercard is coming to $432. Now with the current price at around $410, we typically start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Mastercard is an incredible company. We had a very quick run through, and sometimes people do pay a premium for this company, even at a 5% margin of safety. In fact, you are looking at current prices a 5%. So if you are happy with that right now, based on our estimates and judgments, Mastercard is a buy with a margin of safety of 5%. Personally, this is one that I would be looking for a much higher margin of safety and would be looking to buy it below $350. Wall Street, in terms of their forecast, well, they believe the price will go even higher than our intrinsic value calculated, and they see a good 10% essentially upside to the current trading price. So right now for Mastercard, we believe it has a 5% margin of safety, and Wall Street believe on top of that there is around a 10% upside. Moving on to essentially the second company, we have Bristol Myers. Now, they had a dividend increase of 5.3%. Now, this company has been hammered down 31% year to date, significantly underperforming the S&P 500. It is effectively right there at the 52-week low, and they do offer a fairly attractive starting yield of 4.6%. Now, if you're holding Bristol Myers for the last 10 years, you would be down on your position, essentially just on the share price of 1.5%, and we do see it hit its all-time high at the back end of 2022 at just under double the current price at $82. Now, in terms of their dividend safety, well, it has a safe score of 79, market cap 101 billion. It is therefore a mega cap company. Now, in terms of recessionary metrics, they maintain the dividend. They did effectively have negative 21% sales, and they also outperformed the S&P with a negative 32% return. Now, we see their dividend increase. I do like to see this. It is above the essential average inflation over the last 40 years of 4% that we advocate on the channel to always get above. 7% over the last 5 years, again fairly positive, but a weak 3% over the last 20 years, so something just to bear in mind. And they have been increasing those dividends for the last 16 years. Now, it should come as no surprise that this company is undervalued. We can see that based on dividend yield theory, 4.8% versus the 5-year average. Likewise, that forward PE sitting well below the 5-year average of 9.2. And we can see the healthcare sector PE significantly higher at 16.4. One thing to note is just because a company is trading at or near its 52-week low, do remember that is not purely an essential signal for undervaluation. Likewise, a 52-week high of a company like Mastercard is not a signal for overvaluation. Now, in terms of free cash flow payout, below 60% is my personal preference, but you could go below 50% if you want to be specific to the industry for biotechs. Now, over the last 6 years, we do see it around that. In fact, 2017, it was the highest, 61% for that period, and it has come down to around 29%, now sitting at 39%, although 2023 is expected to be slightly higher. So I do see why that dividend right now is safe. Free cash flow per share has been increasing over the last 10 years. Do note some inconsistencies, but overall, not only is it moving in the right direction, but 2023 and 4 are expected to increase on 22's position. Sales growth, slightly inconsistent. We do see some years of negative growth. We see a year of flat, which was the most recent year, but do note 2023, based on the trailing 12 months, is expected to see a decline from the previous year. Numerically, for those that like to see it in numbers, 16 billion in 2013, 46 billion in 2022. So yes, it has increased, but do note the inconsistencies of the year-on-year increase. Shares outstanding for Bristol Myers, well, they do issue shares, so that is a negative, so they have diluted your position if you were to have held the company since 2013. In terms of the ROIC, now, yes, it is above 10%, but again, we do see some inconsistencies 2019, 2020, but it is positive to see that it has picked it back up, and 2023 is expected to be consistent at around 12%. Operating margin, free cash flow margin, inconsistent. Again, it seems to be a nature for this company. We like to see above 25% for biotechs, although it has only hit that once in 2016. Free cash flow margin a bit more positive from 2017, where it has been above that level we like to see, and it is good to note that consistency with 2023 expected to be around that level. Net debt to EBITDA, remember the strength of the balance sheet as well as showing us effectively how that dividend is safe. 1.55 in 2022, right there at that maximum we like to see, although 23 is expected to climb slightly higher, but I do see why this does look to be a safe dividend play. Now, valuation is always important in any company you own. Don't just buy a company if it looks to be undervalued or if it has a dividend. You always need to do your own analysis and essentially see whether or not it looks to be undervalued. So remember, the intrinsic value is just the average of the 4 models for BMY. Now, current price just shy of $50. Now, we start off with 10% margin of safety, $61. If we increase that to 15%, it still looks to be a buy. At a 20% margin of safety, up to 55, and if we go all the way to 25% margin of safety, it is still showing as a buy. So right now for BMY, if it was a company that you're interested, based on our own estimates analysis, you are getting between a 25 to 30% margin of safety. Now, what do Wall Street say? Well, they also believe there to be some nice upside to this company with a healthy yield. They see the upside up to $64 over effectively the next 12 months. So right now, what we are saying is that you are locking in effective 25 to 30% margin of safety, and Wall Street believe there is effectively up to 30% upside over the next 12 months for this company. We then move on to the third company, which is every mouse's favorite company. It is the Walt Disney Company. Now, this isn't a dividend increase, so to speak, but they have now announced a dividend of 30 cents, which will be paid semi-annually, making the effective yield at 0.66%. Now, year to date, they are up after having a very horrid year, up 3%. It is trading towards the mid to lower end of the 52-week range. And for those who have been holding Disney Company over the last 10 years, they would be up 30%. But we can see right here, it did essentially peak at the beginning of 2021 at around $200, around half the price it currently is at. In terms of their metrics, well, they don't have a dividend safety just right now as they've only started to pay their dividends. Market cap, 167 billion. It is a mega cap company. Now, we can see here how that dividends were paid. They were continuously paid over a significant time before that massive effective cut from 2019. Now, when we take a look at the free cash flow payout for what was prior to the dividends being paid, we do see it was sitting around that 30% level. 2019, it got too high and they did effectively cut that dividend, which they have now started to pay. Free cash flow per share, well, before COVID and even before that, we see 372 in 2014. It went up to 656 before dropping. However, do note now from 2022, it has started to pick up, with 2024 expected to be at 443. Still not at the pre-pandemic levels, but it has started to increase or is on the right trajectory based on the estimates. Sales growth does fluctuate. We do note the 6%, which is understandable with the lockdown that was in measure, but they did have points where they did have some very strong revenue growth, 2019, 2022. However, we do see it slip back down to 7% in 2023, so we will be wanting a much higher rate of increase over the next few years. Total sales, well, it has nearly doubled from 48 billion to 88 billion over the last 10 years. And shares outstanding, they essentially did share buybacks over a certain period, 2014 to 2018. However, they did share issuances, so diluted your position. And if you look over the last 10 years, they have actually increased those shares outstanding by around 700 million. Therefore, your position would have been diluted. ROIC, they had some very strong double-digit figures from 2014 to 2018, although this did drop, and whilst it is starting to increase, it is at a much slower rate than what I personally would like to see from any company. Then we look at the margins. Again, a very similar story. This is a company that did have strong margins and free cash flow margins. However, not only has it slipped, but they have found it difficult to bring it back to the levels that we have previously seen and come to like with this company. Net debt to EBITDA, we would like to see a maximum of around 3. We do see it go slightly higher over the last few years, but it has started to come down, which is what I like to see. 1.99 in 2023 and is expected in 2024 to come down even slightly lower. So they are making way on that balance sheet. Now, in terms of the valuation for Disney, and as always, if you enjoy the content, values being provided, don't forget to smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of the model to run companies of your own to get your own intrinsic value and acceptable buy price, then don't forget to click on that pinned comment below. So intrinsic value, we're getting to $116 with the current price around 91. Margin of safety, as always, at 10%. It signals to be a buy up to 104. And if we go to 20%, we can see pretty much right now, based on our estimates and judgments, you are getting a 20% margin of safety. But personally, you also have to understand the macroeconomic conditions, especially with Disney, and whether or not you see this company to continue to grow, as we have seen many, many years ago. We do like to see double-digit increases on that top line. So if they can turn that around as well as their free cash flow, then it could be a very good value right now. Wall Street, in terms of what they believe, or they see this price increasing to around $109 over the next 12 months. So they do also see this as a buy with essentially around a 20% upside. Now, on to the next stock. We have our first REIT, which is Alexandria Real Estate. Now, they increased their dividend by 2.4%. Year to date, they are down around 15.5%, although over the last 5 days, it has come up quite significantly, up 10%. It is trading still towards the mid to lower end of the 52-week range and does offer a yield of 4.2%. Now, if you were holding this REIT over the last 10 years, you would be up around 98% purely on the share price, and we do see it hit its peak at the beginning of 2022 at around $222, nearly half the price it currently is at now in terms of the all-time high. Now, in terms of what we like and the dividend safety, 76 in terms of the metric, market cap 21 billion, it is a large cap company. Recessionary metrics, it is essential to be aware that they did cut this in 07-09, had around the average growth of companies in the S&P 500 with negative 6% sales, but they did also underperform the S&P negative 68%. Fairly decent yield, and the growth 5% over the last full year, 6% over the last 5 years on average, 4% keeping up with inflation over the last 20 years, but they did have a mediocre 2.4% increase this year. In terms of increases, well, they have been paying increasing dividends over the last 12 years. And in terms of dividend yield theory, we see that sign of undervaluation. Forward P to AFO, again, that other sign of undervaluation, with the sector PE slightly lower at 13.7. In terms of the adjusted funds from operation payout, which is what we look at for REITs, free cash flow, it is more volatile for REITs, so we tend to ignore. Below the 90% that we look for REITs, and we do see the last few years below 80%, with 2023 expected to climb lower, which is positive for that dividend safety. Adjusted funds from operation, whilst it hasn't been consistent every year, it is still growing from $4 in 2013 to $6 in 2022 and expected to go higher in 2023. Now, when we look at the essential sales growth, double digits, which is what we love to see. We do look for around 5 to 10% for REITs, moderate growth, but it looks like ARE has done a phenomenal job, especially over the last year at 22%, with 2023 again expected to still be double-digit increases. In terms of the sales, well, numerically, 0.63 billion in 2013, 2.59 billion in 2022, and again expected to increase in 2023. Do note, though, with essential REITs, it is fairly typical for them to dilute your position as a shareholder by essentially issuing equity, as we see here, to fund property acquisitions. The reason for this is they do retain a little of that internally generated cash flow after paying the majority out as dividends. So one thing just to be aware of. ROIC with the REITs, we do look for 3 to 5%. 10% or more for typical companies, but for REITs it does effectively come lower. It has been a little bit too low for my liking, so I would like to see this go up not only to 3% but higher to 4% if possible over the next year or two. Operating margin, it has been decreasing, so again something to keep an eye on. I would like this to either stay consistent or be increasing. Remember, the higher the operating margin, the higher that bottom line net income should be, which in theory means the higher the dividend growth should be for investors. Net debt to EBITDA is 5.5 for REITs. Now, what we do see, it has been straddling on the higher end rather than the lower end, but it is 5.86 in 2022, although expected to go slightly higher in 2023, so something just to be aware of. Now, in terms of the valuation model for ARE, and for those that don't know, for REITs, we do exclude Graham's valuation as it is not applicable. $120 is what our intrinsic value comes to, and lo and behold, we see the current price essentially reflecting that. So we do believe that ARE is currently trading at fair value at its intrinsic value. What do Wall Street believe? Well, they believe the share price over the next 12 months to actually go higher by around 10 to 15%, up to $137. Now, in terms of margin of safety that I would use personally, it would be around 20%, so around that $96. Although what we could see with ARE is that is still higher than the 52-week low, so there are chances that it may come back down to that level, but that does depend on the individual investor. The fifth stock and dividend increase we have is Tyson Foods, which increased their dividend by 2.1%. Now, year to date, they are down essentially 21%. They are trading towards the mid to lower end of the 52-week range with a forward yield of just shy of 4%. Now, if you were holding this over the last 10 years, yes, you would be up 50%, which is fairly mediocre, even if you consider those dividends not reinvested. And we do see its all-time high of around $100, twice the current trading price. So it would be interesting to see if you believe it will go up to that all-time high and even higher over the next few years. Now, in terms of their dividend safety, it is very nice, a 90 score, making it very safe, and at 18 billion market cap, it is a large cap company. Recessionary metrics, well, they maintained their dividend, they didn't increase, they didn't cut, above average growth of 0.6%, and they essentially had a recession return in line with the S&P at negative 55. Now, over the last 10 years, they have increased it by double digits at 10% on average, as well as the last 20 years. So it was a little bit of a surprise and a little bit of a disappointment that they did have that increase, which was effectively below inflation. Now, they have been increasing their dividends over the last 11 years consecutively. Now, dividend yield theory, we can see another sign of undervaluation, which seems to be the majority of the cases of those that have increased that we've analysed today. Forward P, however, is significantly higher than the 5-year average at 26.8. Now, in terms of the free cash flow payout, we do see that they do have a negative. They had a loss in 2023. And even prior to that, we do see some high percentages at 83% in 2022. And 2024 is expected to go even higher. So something just to keep an eye out for Tyson Foods in terms of their free cash flow payout. Free cash flow per share again, we do see 2014 to 2022, very minimal movement, lots of inconsistencies, ups and downs, and we do see 23 at a negative. So all of these things are to consider before making any investment as a potential investor or as someone who does already own shares. Sales growth, they did have some good years at double digits, some years of between 3 to 7%, although do note 2016 wasn't the greatest year, as well as 2023 they did have a reduction, and considering they haven't kept up with inflation, on top of that they had increased their top line in terms of real numbers. Numerically, how does that compare then? 38 billion in 2014, 53 in 2023. Shares outstanding, they do typically do share buybacks, but do note the share issuances from 2014 to 15, and therefore over the last 10 years they have really only bought back around 10 million worth of shares. Now, when we look at the ROIC, very nice to see the majority has been above that 10%, although it did come down quite significantly in 2023 due to the loss. And on top of that, that is essentially why the share price has taken quite a massive tumble. Now, in terms of the margins, it is one that I've mentioned continuously. The consumer staples do struggle with these margins that we tend to look for. We do see it well below 16%. 1% essentially meaning their top line is very, very squeezed, and that is why we see a bottom line net loss due to the fact that their top line and their operating margin is very, very minimal, and which is why we look for something around the lines of 16%. Free cash flow margin, again, it isn't one that they are managing to get to that level that we like to see. Net debt to EBITDA, though, it does show that their balance sheet is in a fairly good shape, although do note that large increase from 22 to 23, although 2024 is expected to come down, but still it does look like that dividend is safe. So in terms of their valuation, and remember, if you enjoy the content, value is being provided, go ahead, smash the like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And don't forget, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, then do go ahead and click that pinned comment below. So margin of safety, if we start off with 10%, well, it looks pretty much like you are locking in a 10% margin of safety at the current trading price. What do Wall Street say? Well, they say over the next 12 months, they believe the share price to go up by around 10%, pretty much in line with our intrinsic value. So based on our estimates and judgments, we do effectively see a 10% margin of safety, with Wall Street showing around a 10% upside. Now we move on to the final company, which is CVS Health. Now we do see that they did have a dividend increase of 10%. Now this is one that we have analysed on the channel, in fact yesterday, and in a lot of detail. So if you are interested in seeing the valuation of CVS Health, understanding the dividend increase as well as the financial metrics and the valuation, do go check that video. As always, if you enjoy the content, don't forget to smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And don't forget to click on that pinned comment below and grab yourself a copy of the valuation model. As always, have a great day and catch you on the next episode.